All right, guys, this is a big one. So in this video, I'm gonna be breaking down exactly how the banks and the market makers run their business and how they systematically take money from retail traders or just lesser skilled traders' accounts and put it in their own. So you're gonna learn all those secrets, and then at the end, I'm gonna give you an exact strategy that you can use and plot on your charts to get insanely good trading opportunities over and over and over again. So let's get into it. Imagine this, you're sitting at your desk, staring at your trading screen, heart racing. You got your strategy, you've done your research, and now you're ready to make big money. But guess what? Here's the cold hard truth. 95% of retail traders like you are gonna lose all their money over time. A big question that you need to ask is, where does all that money go? It's not just vanishing into thin air. Well, here's not that well kept of a secret. All the money that retail traders lose, and losing traders in general, filters to the banks and the market makers and the professionals that run these markets. The question that you need to be asking as a trader is, how do they do it? How do they always seem to win? How do they finance these huge skyscrapers and all this infrastructure? That's the question that you really need to be interested in. Stick with me till the end of this video, because I'm gonna blow the lid off a secret that Wall Street doesn't want you to know, and I guarantee you it's gonna change the way that you see trading forever. Let's kick this off with a gut-punching statistic. Like I said before, 95% of traders lose money over time. In fact, a 2021 study performed by the University of California found that the average investor underperforms the market by 1.5%. And day traders, they fare even worse. Most day traders will quit the business within 2 years. Why is this happening? Is it that retail traders are really that bad at trading? Not really. The facts are is that the game is rigged, and not necessarily in an illegal way, but the facts are is that retail traders don't even really understand the game they're playing. They're taught to do specific things in specific ways because they're following the mainstream narrative, and that narrative is what leads them to lose. Here's the deal, the market isn't a complete level playing field as we would all like to believe. In fact, it's ran a little bit more like a casino, and the banks, the market makers, the hedge funds, and the big players have the advantage over the retail trader or the little guy. Retail traders are up against players with better tech, deeper pockets, and in some cases, insider information. How can we even compete? Well, I'm gonna teach you exactly how you can compete. But first, let's break down how they dominate and how your money ends up in their pockets. So why do institutions and market makers have such a huge edge? Let's dive into some eye-opening facts. Institutions like Goldman Sachs or JP Morgan have cutting-edge tools that retail traders can only dream of. They use high-frequency trading algorithms that execute trades in microseconds. That's faster than you can blink. These algorithms can scan multiple markets, exploit tiny price differences, and front-run your orders. A 2024 report from BMLL Technologies showed that high-frequency trading algorithms make up nearly 50% of the US equities market's volume. Those of you that are retail scalpers trading that 1-minute chart, you're stuck with a basic trading app and a lagging internet connection. If you've been around trading in markets for any reasonable amount of time, you've inevitably heard of smart money. That's what we call institutional investors, banks, and hedge funds. They have proprietary data feeds, teams of PhD analysts, and direct access to market insiders. The simple fact is, they know what's moving the market before you do. For example, market makers like Citadel Securities or Virtu Financial get paid for order flow that comes from brokers like Robinhood. This means that they see your trades before they ever even hit the market, giving them a sneak peek at retail trader sentiment. I would say that's pretty valuable information. It's like playing poker where they could see your cards, but you can't see theirs. Here's another fact. Institutions trade with billions of dollars. This lets them move markets and absorb losses that would wipe out a retail trader. They can hold positions longer, they can manipulate markets to a certain degree, and they could run stop-loss areas to shake out retail traders. A 2025 study from Mind Math Money showed that institutions' large orders can directly influence market prices, creating moves and trends that traders often misread. Here's another inside tip for you. Market makers who are tied to big banks have a very unique role. They're tasked with providing liquidity, which means that they set the bid and ask prices that you trade at. When it comes to thinly traded markets, they can easily widen the spread, which will significantly impact your trading fees. Plus, market makers are backed by regulations like National Best Bid and Offer, which ensures that they always get the best prices before they pass it on to you. And retail traders typically get filled at the worst prices, if you've had that experience. These advantages no doubt stack the deck against retail traders, but here's where it gets really wild. Let's talk about how your losses fuel their profits. As you know, every single time you press the button to trade, you pay a spread, and those tiny fees add up fast. In 2023, the SEC estimated that market makers earn around $10 billion per year on average, and that's just in the US markets alone. For retail traders, these fees are like a little hidden tax that adds up. While a necessary evil, because we need to access the brokers, those of you that are scalpers, these can significantly impact your trading performance over time, slowly eating away at your account. So if you add your fees that you're paying on top of having losses, this just means your money's draining faster. And this whole payment for order flow thing is a rabbit hole all on its own. Here's a wild one. In 2021, a study by Science Direct found that when Robinhood suffered an outage, that liquidity in stocks with high retail interest significantly improved. This is simply because market makers couldn't exploit order flow during that time. Your trades are literally being used against you. And here's a big one, stop loss hunting. Ever notice that the market always just seems to seek out exactly where your stop loss is? That's not a coincidence. Institutions and market makers can see where clusters of retail stop loss orders are thanks to their data advantage. They could easily push price to stop loss areas, forcing you to sell at a loss and for them to be able to accumulate inventory at discount prices. Typically, how stop loss harvesting works is exactly like this. You have a nice little consolidation range, it eventually breaks out, and right about the time that most retail traders are convinced that this is the real breakout, it's really taken off, they buy. But the market makers know that your stop losses are going to be right here, and right here, and they're not going to just let you win. So typically what they'll do is they will run the market aggressively down through those levels, harvest those stop losses, meaning they stop you out, they take the other side of that trade, they get a great position down at this low discounted price, and then they still knew that the market was ultimately going to go up. So what do? They let it go back in its original trend, and then they cash out. You know who jumps in and buys as the market keeps going up? Retail traders. They're always on the wrong side of the market. And stop loss harvesting, if you understand it, that could be your key to not falling victim to activity like this. Now let's enter the world of behavioral exploitation. This is where the real cheddar's made. Retail traders are emotional. They panic sell, they chase trends, and they generally overtrade. Institutions know this and they exploit it. And the sad part is that the market makers and the banks know that the guy with the small account, the retail guy, has big hopes and dreams, that he thinks he's going to take that little bit of money and turn it into a huge sum of money. And they're exploiting that. They know that you feel pressure to see significant compounding growth, but they also know that you can be easily pushed out of the market. All they got to do is convince you to trade with high leverage, and they can push you right into that pain zone and get you to close that trade at a loss. Your loss equals their profit. Now let's talk about the leverage trap. Many retail traders use way too much leverage, particularly if they're trading CFDs to amplify their profits. A 2024 Reddit thread on IG Trade showed that 70% of CFD traders lose money typically because they get wiped out in one big over-leveraged trade. The brokers and the market makers who provide this extreme leverage know that when you blow up your account because of over-leveraging, they're the ones holding your deposit. And guess what? It's theirs to keep. The cycle is relentless. Retail traders lose money through spreads, fees, stop outs, bad trading decisions, and all that money flows directly to the market makers and banks. It's a wealth transfer going from Main Street to Wall Street every single day. So what's the big secret I promised you at the end of this video? You're gonna get it right now. The fact is, the market is not designed for you to win. However, you absolutely can level the playing field. I'm going to show you two very simple but extremely effective ways to technically approach the market. So before I teach you what I think are the two most important things that you need to know when it comes to doing technical analysis, I first need to briefly educate you on a methodology that we practice and have taught here for a really long time, and that is the Forex master pattern. If you have seen any of my other videos, I typically touch on it at least once. So the Forex master pattern is a sequence of events that we follow to attach ourselves to what is likely going to happen next in the market. And it's pretty simple. It starts with phase one, which is the contraction phase. This is the tightening of the market. Then that leads to phase two, which is the expansion, leaving that range. That's usually like whipsaw type action. This is a very important phase of the market, which we'll get into in a second. That then leads into the third phase, which is the profit taking or the trend phase. And in that phase, the market will finally travel to higher or lower prices. And then, you guessed it, the three market phases starts over again. Now, these three phases are happening in all markets on all time frames, and they're happening all the time. It never stops. So our methodology is all about attaching ourselves to where we are in these three market phases. That way we can come up with a pretty good idea of what's likely to happen next. So that all being said, let's get into the charts. At TradeATS, one of the things that we're really famous for is an algorithm I wrote a long time ago that tracks the master pattern, tracks the accumulation distribution cycles. In this video, I'm going to teach you how to map this pattern without using our software. So I'm not here to sell you anything, but if you do want help with automated analysis, we do have that available. You can check it out at tradeats.com. But let's delete it for now. The first thing I'm going to teach you when it comes to doing effective technical analysis is probably in reality the most important thing that you can learn. And it's very simple. It's understanding how to marry a directional bias. And what that basically means is understanding which direction you should only be trading in at any given time. Let's take a look at gold. So on the gold chart right here, I have the daily chart pulled up. Now, one of the things you need to understand about directional bias and why it's so important is because all the big moves in the market happen over a period of time. It's not instant typically. And the reason why this is because the banks and the hedge funds and the market makers that really push price, they aren't going to do it in a moment. They are building into positions and then scaling out of positions. They simply cannot make a return on the hundreds of billions of dollars that they're managing in the blink of an eye. They have to do it over time. And that is why we want to follow the higher time frames like the daily, the weekly, and the monthly. We can clearly see that gold is going up here. So just for quick reference, if you're looking at a 4-hour and below on your chart, you're going to be dealing with a lot of high frequency trading algorithms. That's where you're going to get a lot of whippy, erratic movement, things that could stop you out. And that's what I found is about the threshold. If you're above the 4-hour on your directional bias, then you're going to start to see the big picture. You're going to see things shape up over time. And that's really what's going to lead to capturing really big moves. So I always push people towards doing like intraday swing trading or looking for 50, 100 pip opportunities if we're talking Forex that are going to take place over the course of like a week or a few weeks. That's really where you're going to do well with this methodology. The fact that we see that this market is going up in an uptrend is good. That tells us that we generally want to be trading long. What should we be doing on a per candle basis? That's really where the magic is. So the key to understanding what you should be doing for your directional bias on a per candle basis, again, comes down to understanding the master pattern. So looking at this, we have the contraction, expansion, and then the trend phase. When I'm looking at this price action down here on the daily, do I see these phases clearly? Now, it doesn't matter how many candles are in a contraction or in an expansion. It doesn't matter how big the contraction zone is. Those things don't matter. What matters is, does it have the characteristics of these phases? That's all that matters. So let's take a look. I'm looking for a contraction and I'm looking for that expansion activity. I want to find something that is in phase 1 or 2 because I'm looking for phase 3. That's the phase I really want to participate in. So do I see anything that's in phase 1 and 2? Let's take a look. So here's my box here. So where in this recent price action would a box fit? I need a contracting of price. So what draws my eye out right here is this price action right there. I can see that we have a box right there. So I'm going to highlight those few candles there as my contraction phase. Now, the reason why I'm also drawn to that specific set of candles is what's happened right after it. Do you see clearly what it is? You can see that we had an expansion leg to the downside and upside. That's our second phase. That tells me not only do we have a confirmed contraction zone, but it shows me that this is a high interest point for the market makers. If it wasn't, they would not be creating a range like this. So what I'm going to do is I'm going to take this line and I'm going to mark the center of the box, which is going to be what I call fair market value. So we could drag that down, we'll put that right there. And the reason why we call this fair market value is simply because in this contraction point, for a brief moment through these candles, the market, when it comes to supply and demand, both buyers and sellers have agreed on price. That is why it stopped right here. If they didn't agree on it, it would be in the trend phase. It would keep going. So that really is the beginning of everything that happens in the market, is accurately spotting that point. And you can do it by seeing if there are simultaneous lower highs and higher lows coming into that kind of wedge-like pattern, and then seeing that second phase, the downward expansion and the upward expansion. And then that is where you can confidently draw your fair market value price. Now let's look at the current candle where I'm at. I'm looking for that third market phase, that trend phase. So what likely could happen here? Well, I see the market expanded down, it expanded up, it expanded down again, and now it's up above fair market value. So a general rule of thumb is that you want to look for your directional bias in the direction based on if you're above or below fair market value on your higher time frame. So even though the candles are going down right now, what I would prefer is I would like to see a rotation in these candles and it to trade away from fair market value. That's how you catch the big runs as they really start to take off. And then I'd look for the daily to trend to higher prices up here. Now, the opposite of that can happen as well. The daily can come down through fair market value, get in here, settle below that, and then trade down. And in that case, if that would happen, I would look for it to trade below fair market value and hold, and then trade towards this low right here. Now, if that happens, you can absolutely start trading those downward candles from this level. Nothing wrong with that. And in fact, it'll probably lead to a big move. But at the very least, you can target the swing low point of this expansion cycle. Now, a question that a lot of people ask is, well, how many of these expansion legs can happen? And I'll tell you, through my back testing over so many years, I've counted up to like 9 or 10 expansion legs in my back testing. So this could literally go take out low, take out high, take out low, take out high, take out low, take out high, and continually funnel out. Now, the good news is that you can still make money and trade inside the expansion legs. But what you want to do is you want to favor the side of that fair market value line on. If you're above it, you want to look for upward turning candles. If you're below it, then you want to trade downward turning candles. Now let's turn our attention to the lower time frame, because we can make even more magic happen right there. So when it comes to lower time frames, this is where you can really pinpoint your entry and exits. And if you've done your homework right on the higher time frame, it becomes relatively easy over on the lower time frame. So let's take a look. I want to draw your eye right here where I wrote daily settles above value. See these candles right here? We already had our fair market value price from way back in here. So that is still relevant even down to this last turn that happened on the daily. So we see that it's settled above and it's starting to turn up. And we already are favoring the long side of the market. We're waiting for things just like this to happen. So it's nice that it worked out that way. So let's go over here. Here's the daily value line right here. That's showing you that exact level. Now we can see the 30 minutes started to pull above that. That's exactly what we want to see. But what do we want to do on the 30 minute to help us pinpoint our entries and exits? It all comes back to understanding that master pattern, those 3 market phases. I got my pieces here for my framework, but I'm going to look for the exact same thing on the 30 minute as I do on the daily, but I'm going to do something a little different with it, which you'll see in a minute. So what am I going to do? I'm going to look for that contraction, that expansion phase, and I want to look right here around where I'm getting that turn. So what jumps out at me? Well, I could see right here, if I take this box and I put it right there, that's a nice contraction point, and I like that contraction point because it's giving me that 1-2 leg expansion. You see how clean that looks? That is a great spot in the market to leg onto. So I'm going to grab that and I'm going to stick my fair market value line right there. So now that I'm expecting that the market is going to start moving up because of my directional bias and the catalyst or the clue I'm getting right here, what I want to do with this market is I want to look at these minor values on the lower time frame, and I want to look to buy below them. Why is that? Because when the market is expected to go up, we expect the value to rise based on the daily, then I want to get an undervalued price. And how do I know I'm getting an undervalued price? It's because I know value was established here by this neutral zone. I know that market is traded up. When it trades below, it's going below that value point, and I know I'm getting a discount based on what the trend is shaping up to be. So as you can see, when the market peaks below that level, it's usually not lasting very long, and then it gets you into the profit above value. So the whole entire goal with what we call the basic strategy is to expertly identify your directional bias by doing this work first, and then finding your smaller value points on your lower time frame, and then buying or selling above value. So you want to buy below the value and then sell into the rise above. Buy below, sell into the rise. And even if it doesn't hit the profit phase or the trend phase of the market, you can do well just by buying and selling above and below value, just like this here. So let's keep going. I got some more boxes here. So where is another good contraction zone? Well, this one also stood out to me right here. If I drop my box right there, you'll notice same thing. I had a clear breakout to the downside and a breakout to the upside, and then it came back and revisited the value point. So that shows me this is a high interest area. So I'm going to stick my box and my fair market value line there, and I'm going to treat this as the exact same way. But keep in mind, the farther that you pull away from value here, you're going to lose probability on your higher time frame that it's going to keep going. Hopefully it does, but you're never going to get a better opportunity than what we call a grade A type opportunity when you're early to a rotation coming real close to that framework right there. So this in reality was the best opportunity. This was that grade A opportunity. This we'll call a grade B. Does not mean that you can't trade it, just means you want to be a little more conservative. But same rules apply. When you're below value, you buy and you sell above value. But you can see this market spiked up here and it didn't want to take off anymore, came back to value. You may have bought it again right here, but in this case, you're probably taking a little bit of a loss right here. That's okay. Losses lead to information. And information's good. A lot of times when we take a loss with this methodology, it's giving us a clue that will lead to a much even bigger trade. So it's always a good thing, no matter what. So I'm looking in here, we're in this consolidation zone right here. I'm gonna look at this as a contraction, this is the expansion, and this is the trend phase that happened here. So I'm looking for a settling point or a new contraction point generally in this area. What stands out to me based off of looking for those three market phases is right here. I see those candles right there. I see a clear expansion to the downside, a clear expansion to the upside, and then we're back here in the range. So I'm going to draw my fair market value line right there at that level. And this is pretty recent. So if you watch this video as it's coming out, that is at $3,387.47 on the price. So that's pretty much where you're working with on value when it comes to the 30-minute time frame. Now, here's what you want to be careful of. And I'm going to save some of this for another video. When you have a fair market value established here and then you stair step down, that gives you an indication of what the market maker's footprint is. Remember, they use this cycle for a number of reasons, or these three market phases, they use it for a number of reasons to accumulate and distribute in the market. I'm just letting you in on the secret of how it's done so that you can follow their footprint. But keep in mind, if you get a contraction below a previous, this could be your first indication that the trend is changing. Even if your higher time frame hasn't shown the candle rotation yet. So keep that in mind. It's a little clue there. I'll expand more on that in another video. So make sure you like and subscribe if you like content like this. So right now I'm looking at that. If anything, you'd want to start to look at trading it short. If you want to, there would maybe be an opportunity trading this back to what we call the center of gravity, or back to that fair market value. There's a gravitational pull coming back there. So if you're a little more advanced, you can take these trades above fair market value short and close below, following this daily rotation. And in that case, if you're going to want to do that, you'd want to manage your risk based off of this higher framework, what we call the highest framework in trend right here. Because if the market does run away on you and it gets back up through this level, chances are the daily's rotating and could be headed for the trend phase that we're ultimately looking for, coming from this contraction and fair market value price on the daily. So that's a little bit about how this works. Keep it simple. Keep it stupid simple. It does not need to be complicated. We get a lot of comments through the YouTube channel and people that join our programs trying to overcomplicate it. Again, asking how many candles is a contraction supposed to be? What's the size? They're trying to impose a bunch of rules, and in reality, it doesn't matter. What matters is seeing the characteristics of the three market phases clearly playing out. The clearer it is, the better that spot on the chart will be in the future. And so to wrap this up, here's your key takeaways. Number one, avoid overtrading. Every trade costs you spreads and fees. Ideally, you want to move to higher time frames. But if you're not going to, if you insist on scalping, then make sure that you focus on very high quality trading setups. Keep your trading to a minimum. Takeaway number two, learn how the market makers run their business, and more importantly, learn what it looks like on a chart. You want to study and understand liquidity zones and stop loss hunting. Those two things will really get you on the right track. If you want a fast track to understanding those things, then I suggest you go take our free course at tradeats.com. Go up to the top of the website, it says free stuff. You could join our Master Pattern Academy. It's 8+ hours of content that I made with my inner circle, showing exactly how all this stuff works. It's free. I got nothing to sell you there. Go take it. It's definitely worth your time. Number three is a huge one. Use low leverage. I know that might feel kind of counterintuitive because you want to make big money fast, but the facts is that time in the market, existing in the market, is what pays long term. If you build a house with small bricks, it's harder to take each one of those bricks away to tear the house down. If you build it with giant bricks, you can just push them over and it's gone. So we always say build with small bricks, small positions over time, and that way you'll get a really consistent equity curve. And more importantly, you won't blow your account. Number four, follow the smart money. Use what I just showed you and see for yourself. If you look at the higher time frame directional bias and you plot fair market value, those two things alone can set you free in this business. Number five is one you probably already know, but it's worth saying again. Control your emotions. This thing is not going to happen overnight. You need to have a long-term plan, and you need to make trading in reality kind of boring. In fact, the more boring it is, probably the better you're doing. So keep it boring, control your emotions, and make progress. The 95% of traders who are losing all their money are only losing because they're playing the game blindly. Hopefully through this video, you've now had a little glimpse into how the system works. Now your only job is to study that system. If you understand how it works, you can flip the script and turn the tables in your favor. I'll see you on the next video.